All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker HOV, Hovnanian Enterprises. Hovnanian Enterprises. Just give me one moment to double check to make sure the stream is fully up and running. And we'll get started. Okay. So Hovnanian Enterprises is a American home building company. They're pretty interesting for a number of reasons. We've looked at a few of the home builders or adjacent companies in that industry on this channel. We do definitely like the real estate industry in general, and obviously the real estate industry has been pretty hot for the last year or so, or 2 years or so, pretty much since the pandemic took off and interest rates dropped and excess money flooded into the market, and then supply dropped off the market. So for a number of reasons, obviously real estate's been booming pretty strongly. The real question on most people's minds is obviously whether or not it will extend. Generally, when looking at the home builders and any companies related to it, I find that they're all trading pretty much at either a gigantic premium or at a gigantic discount in terms of multiples. Just because either A, they're doing really well in relation to the industry and they've been rewarded by the market, or perhaps by algorithms or indexes and other such things, or everyone has a kind of skeptical eye on the other groupings earnings and belief that because of the fact that it's so hot right now that means that the market will eventually bounce and those earnings will drop. This company definitely falls into the latter category. As you can see right here, I've already put in the most recent year of numbers, and they're currently trading at a PE of 1.37 against their GAAP earnings. That is heavily explainable by a very large negative cash charge in this year, which comes as a result of inventory revaluations that they go through and how that affects their deferred income taxes. So this isn't really a real number, but even if you were to subtract it out and put it in a normal tax level for them, which against typical years, which might be perhaps in the range of like 40 million or so, I've already kind of like done this looking at it previously, well then that actually still shifts their PE to 5.57. So even on what you might think of as a normalized earnings basis, it's still an extraordinarily cheap company. Just a small diversion into what their current market multiple is like. I do think that has to do with a number of factors related to their business that I find interesting. One is that they're highly levered. This is a $134 million market cap by my measure, and they have $1.2 billion in book value of debt. So a very highly levered company. We'll see what everything looks like at the end of putting in the rest of their numbers. According as to their equity risk premium, like I said, they're entirely US focused business. And as far as their revenue segmentation goes, 97% of the revenues come from home building and 3% from financial services. So it's a mostly focused business as far as industry goes. And the industry typically is a high quality service operator with generally good margins and generally good sales to capital ratio. So according to the metrics we like, it's usually a pretty nice industry to look at. However, the market typically rewards it with high volatility as a result, which means you typically can see high discounts, and therefore that qualitative factor is often erased by that. So we'll see what that looks like after adjusting for the fact that they're highly levered, because the high leverage definitely means that their discount rate that we're going to come up with is probably going to be very high. So we'll see whether or not they can actually survive that, but hopefully the extremely low multiple that they're trading at counteracts that. So I think it's a very interesting company to look at. As I said, I already put in all the little prep work stuff in the first year of numbers, as I already kind of presented a piece of them. I will play the fourth quarter earnings call as I do the rest of the numbers. There we go.
Good morning, and thank you for joining us today's Hovnanian Enterprises Fiscal 2021 Fourth Quarter Earnings Conference Call. An archive of the webcast will be available after the completion of the call and run for 12 months. This conference is being recorded for broadcast, and all participants are currently in a listen-only mode. Management will make some opening remarks about the fourth quarter results and then open the line for questions. The company will also have webcasting a slide presentation along with opening comments from management. The slides are available on the investor page of the company's website at www.khov.com. Those listeners who would like to follow along should now log onto the website. I would like to turn the call over to Jeff O'Keefe, Vice President of Investor Relations. Jeff, please go ahead.
Thank you, Valerie, and thank you all for participating in this morning's call to review the results for our fourth quarter and fiscal year. All statements in this conference call that are not historical facts should be considered as forward-looking statements within the meaning of the Safe Harbor provisions of the Private Securities Litigation Reform Act of 1995. Such statements involve known and unknown risks, uncertainties, and other factors that may cause actual results, performance, or achievements of the company to be materially different from any future results, performance, or achievements expressed or implied by the forward-looking statements. Such forward-looking statements include, but are not limited to, statements related to the company's goals and expectations with respect to its financial results for future financial periods. Although we believe that our plans, intentions, and expectations reflected in or suggested by such forward-looking statements are reasonable, we can give no assurance that such plans, intentions, or expectations will be achieved. By their nature, forward-looking statements speak only as of the date they are made, are not guarantees of future performance or results, and are subject to risks, uncertainties, and assumptions that are difficult to predict or quantify. Therefore, actual results could differ materially and adversely from those forward-looking statements as a result of a variety of factors. Such risks and uncertainties and other factors are described in detail in the sections entitled Risk Factors and Management's Discussion and Analysis, particularly the portion of MD&A entitled Safe Harbor Statement, in our annual report on Form 10-K for the fiscal year ended October 31st, 2020, and subsequent filings with the Securities and Exchange Commission. Except as otherwise required by applicable securities laws, we have undertaken no obligation to publicly update or revise any forward-looking statements.
Yeah, sorry, I ain't looked at it yet. There's a lot of companies to look at. I ain't got time for them all. I'll get to it. Like I said, I'll take a look at it at some point, but there's no guarantee that I'm going to do any valuation stream for it, so don't necessarily get your hopes up for that. I don't even know what type of business it is, but...
Go ahead.
Thanks, Jeff. I'm going to review our fourth quarter results, and I'll address the current market environment. Larry Sorsby, our CFO, will follow me with more details. I'll make a few closing comments, and we'll open it up to Q&A. On slide 5, we compare our results to our most recent guidance. Although we experienced supply chain delays, our amazing associates found ways to mitigate many of the issues. We managed to deliver a large number of quality homes in the final month and days of the quarter without spending the incremental costs that concerned us. This allowed us to achieve higher gross margins than we anticipated. While supply chain issues prevented us from closing more homes, we were able to report revenues above the midpoint of our guidance. During the quarter, we also achieved lower SG&A and lower debt levels, which resulted in lower interest expense. All of this allowed us to not only exceed our revised guidance, but also our original fourth quarter guidance for gross margin, EBITDA, and pre-tax income. During our second quarter conference call, we talked extensively about the impact of phantom stock expense on our SG&A. During the fourth quarter, our stock price declined, which resulted in a $5 million reduction in phantom stock expense. In the third column of this slide, we show what our results would have been without the benefit of the phantom stock expense reduction. As you can see, we still exceeded our original and revised guidance for EBITDA and pre-tax profit. Further, our SG&A ratio would have been within our guidance without the benefit. Moving on to slide 6, we show year-over-year comparisons for our fourth quarter. Given the supply chain disruptions and labor shortages that have been plaguing many industries, including home building, We are pleased with our strong performance in the quarter.
Also, by the way, I did fix the link tree in the Discord link, so you can find that in there and maybe talk to me about it later.
$18 million. Moving to the upper right-hand portion of the slide, you can see that our adjusted gross margin increased 260 basis points to 22.8% this year compared to 20.2% in last year's fourth quarter. This clearly illustrates that we've been able to raise home prices more than enough to offset the higher labor and material costs that we've incurred. Keep in mind that these deliveries did not get the benefit of lower lumber prices since they started near peak lumber pricing. We expect the lower lumber prices to positively impact gross margins beginning in the second quarter of fiscal 22 as we deliver homes that started after lumber prices receded. In the lower left-hand quadrant of the slide, you can see that our SG&A was 8.6% for the fourth quarter compared to 9.6% in last year's fourth quarter. If you ignore the benefit of the phantom stock expense, it still would have improved to 9.2% this year. In the lower right-hand quadrant of the slide, we show that adjusted EBITDA increased 39% from $87 million in last year's fourth quarter to $121 million this year. On slide 7, you can see that our adjusted pre-tax income improved 80% to $81 million compared to $45 million last year. Turning to slide 8, for the full year, our earnings per share, ignoring the benefit of the valuation allowance reduction, grew 210% from $7.03 in fiscal 21, in fiscal 20 to $21.77 in fiscal 21. This is a significant year-over-year growth, and we expect to have continued significant improvement in fiscal 22. We already have the majority of our first 2 quarters contracts in backlog, about half of our third quarter, and we're beginning to fill our fourth quarter pipeline. Let me talk about the sales environment. On the right-hand portion of slide 9, we show contracts per community for the fourth quarter in each of the last 3 years. You can see that our contract pace jumped from 9.5 in the fourth quarter of fiscal 19 to a white-hot pace of 16.5 in fiscal 20. That was a 74% year-over-year increase. For over a year now, we've been saying that the sales pace that we achieved in fiscal 20 was unsustainable and that year-over-year comparisons would be challenging. As we had anticipated, with significant home price increases and metered sales, the housing markets returned to a more normalized sales pace in fiscal 21. Our contracts per community of 10.2 in this year's fourth quarter were below fiscal 20's white-hot fourth quarter, but up 7% compared to a more normalized fourth quarter in fiscal 19. Further to the left, we show that the average fourth quarter contract pace from 97 through 2002 was 10.2. As we've said many times before, that was a time that was neither a boom nor a bust for the housing industry. While our sales pace in the fourth quarter of 21 slowed to a more typical historical pace, both home prices and gross margins on homes that we sold in the fourth quarter were much higher this year than they were a year ago. We expect this will lead to higher levels of profitability in future periods as we deliver those homes. On slide 10, we show contracts per community on a monthly basis from December through November. The most recent month is in dark green, the same month a year ago is in light blue, and the same month 2 years ago is in gray. For the past 7 months, our contracts have been lower than last year's blazing pace. However, we compare favorably every month with 19's more historical, typical contract pace. We believe our current sales pace is healthy and much more sustainable than the COVID demand surge pace during fiscal 20. Further, the most recent month of November shows that we're closing the gap on sales pace, notwithstanding significant price and margin increases this year. Our contract dollars in November of 21 actually increased 10% over last year. This is particularly noteworthy as we've raised prices considerably since last November when sales were white hot. Furthermore, this year's November only had 4 Sundays compared to 5 Sundays last year. The housing market definitely continues to remain really solid. On slide 11, we show what our community count was at the end of every quarter since the last fiscal year end. As you can see, primarily due to selling through communities at a significantly higher than normal pace, as we've discussed before, our community count had been declining each quarter up until the end of the third quarter of 21, when we had a sequential quarterly increase. As we projected, the positive trend continued during the fourth quarter. We grew by 20 communities to end fiscal 21 with 140 communities. Not only was this up from the end of the third quarter, but it was also an increase from the end of last year. We expect our community count is likely to experience up and down quarterly fluctuations during fiscal 22, including a decrease in the first quarter. However, given no material changes in market conditions, we expect to end the year with a community count at or slightly higher than we ended fiscal 21. Further, we expect to maintain a higher average community count for fiscal 22 compared to fiscal 21. On a daily basis, we all continue to see hot headlines about supply chain disruptions and labor shortages. These problems are not just impacting the home building industry, but they're wreaking havoc on just about every industry across the globe. At this point, we're not seeing any relief on construction cycle times, and we've therefore included the current extended cycle times in the guidance that we're going to give you toward the end of our call. As we have now begun our fiscal year, we have the headwinds of continued supply chain disruptions and a slower sales pace compared to the white-hot levels that we achieved in fiscal 20. However, these negative influences should be more than offset by our increased community count, higher gross margins, and higher selling prices, which we expect should allow us to achieve revenue growth and significant profit growth in fiscal 22. I'll now turn it over to Larry Sorsby, our Chief Financial Officer.
Thanks, Ara. I'm going to start with the progress we've made in growing our lot position. Turning to slide 12, we show that year over year, our lot count increased by almost 5,000 lots, or by 19%. We've been steadily increasing our lot position, and we expect to see our lot count continue to rise in fiscal 22. Based on fiscal 21 deliveries, this equates to a 5-year supply. We believed that the COVID surge in sales demand we experienced in fiscal 20 and fiscal 21 was unsustainable. As a result, we conservatively underwrote all new land acquisitions since July of 20 with pre-COVID contract paces. Additionally, when we underwrote the lots controlled between April and September of 21, we were using then current construction costs, including lumber costs, that were significantly higher than today's cost. As a result of subsequent declines in lumber prices, we now expect even higher margins on those recently acquired land parcels. The market for land acquisitions remains rational, and we continue to feel very comfortable with all of the acquisitions we've made over the past year. Keep in mind there's a lag between when we place lots under our control and when those lots will be fully developed and we can open a community. Most of the land we put under control during our fourth quarter of fiscal 21 will not be open for sale until fiscal 23 and beyond. While it's too early to give specific guidance, we do expect to grow our community count in fiscal 23. We now control 100% of the land and communities necessary to achieve our expected growth in profits during fiscal 22 and control roughly 90% of the lots to achieve our expected additional growth in fiscal 23's profits. Today, our land acquisition teams are focused on obtaining control of land and communities for home deliveries in fiscal 23 and beyond. Turning now to slide 13. During the fourth quarter of fiscal 21, our land and land development spend was $167 million, which brought the total spend for the full year to $698 million. That is a 12% increase over the $624 million spent during fiscal 20, excuse me. This further demonstrates we're investing the money needed to grow our community count. Turning to slide 14. Even with that increase in land spend and an early retirement of $181 million of senior secured notes during fiscal 21, we ended the fourth quarter with $381 million of liquidity, well above the high end of our liquidity target range. We continue to have excess liquidity, and today our land teams are busy contracting additional land parcels across the country. Turning to slide 15. Compared to our peers, you see that we still have one of the highest percentages of land controlled via options. We continue to use land options whenever possible to achieve high inventory turns, enhance our returns on capital, and to reduce risk. Our use of land options increased from 63% at the end of fiscal 20 to 66% at the end of fiscal 21. Turning now to slide 16. Compared to our peers, you see we continue to have the second highest inventory turnover rate. Our inventory turns were 20% higher than the next highest peer below us. High inventory turns are a key component of our overall strategy. We believe we have opportunities to continue to increase our use of land options and to further improve inventory turns and our returns on inventory in future years. On slide 17, we show the dollar value of backlog, including domestic and unconsolidated joint ventures, increased 17% to $1.9 billion at the end of the fourth quarter. The strength of this backlog, including a solid expected gross margin, sets us up nicely for even stronger financial performance during fiscal 22. Our financial guidance for the first quarter, the second quarter, and the full year for fiscal 22 assumes no adverse changes in current market conditions, including no further deterioration in the supply chain. Further, it excludes any impact to our SG&A expense from phantom stock expenses related solely to stock price movements from the $84.26 stock price at the end of fiscal 21's fourth quarter. As you review our guidance, keep in mind that we are not a builder who primarily builds spec homes. We already have more than half our full year's projected deliveries and contract backlog, which provides us with an even higher degree of confidence in our projections. On slide 18, we provide guidance for the first quarter of fiscal 22. We expect total revenues for the first quarter of fiscal 22 to be between $640 and $670 million. We also expect gross margins to be in the range of 20.5 to 22% compared to 20.7% in last year's first quarter. SG&A as a percent of total revenues is expected to be between 10.8 and 11.8%. Finally, we expect our adjusted pre-tax profit for the first quarter of fiscal 22 to grow to between $30 and $35 million, up between 40 and 63% compared to a $21 million profit in the same period last year. On slide 19, we provide guidance for the second quarter of fiscal 22. Due to the significant improvement in expected profits during the first half of 22, we felt it would be helpful to show 2 quarters of guidance. However, we do not plan on providing 2 quarters of guidance in future periods. We expect total revenues for the second quarter to be between $700 and $750 million. We also expect gross margins to be in the range of 23 to 25%, up substantially compared to the 21.3% in last year's second quarter. SG&A as a percent of total revenues is expected to be between 9.5% and 10.5%, compared with 11.7% last year. Finally, we expect our adjusted pre-tax profit for the second quarter of fiscal 22 to grow to between $60 and $75 million, up between 93 and 141% compared to a $31 million profit in the second quarter last year. On the next 3 slides, I will provide guidance for all of fiscal 22, but will also show actual results for fiscal 19, 20, and 21 to provide context to how our results have significantly improved over the past 3 years. Turning now to slide 20. In the upper left-hand portion, we show full-year total revenues have increased from $2.02 billion in fiscal 19 to $2.78 billion in fiscal 21. For fiscal 22, we expect to report another increase with total revenues between $2.8 and $3 billion. The last year has been a wild roller coaster ride for cost, particularly for the cost of lumber. For most of the homes that we will be delivering during the first half of fiscal 22, not only have we already sold them, but we've already started construction and therefore locked in the cost of lumber. This provides us with strong transparency to the expected improvements in gross margins we're projecting beginning in the second quarter of fiscal 22. After increasing gross margins to 18.4% in fiscal 20, our gross margins improved another 240 basis points to 21.8% in 21. In fiscal 22, we expect to increase margins to between 23.5% and 25.5%, up another 170 to 370 basis points compared to fiscal 21. On the bottom of this slide, we show that our SG&A as a percentage of total revenues has declined steadily since fiscal 19's 11.6% to 9.9% in fiscal 21. For fiscal 22, we expect SG&A as a percentage of total revenues to be between 9.3 and 10.3%. In the bottom left-hand quadrant, you can see that adjusted EBITDA grew from $174 million in fiscal 19 to $364 million in fiscal 21. We show in fiscal 20 we achieved a 35% growth in adjusted EBITDA. In fiscal 21, we grew adjusted EBITDA another 55%. Based on the midpoint of our adjusted EBITDA guidance, we expect to achieve an additional 19% growth in EBITDA in fiscal 22. These increases are representative of the progress we've made in materially improving our operating results. Turning now to slide 21. We show adjusted pre-tax profit on the left half of the slide. After increasing adjusted pre-tax profits by 288% in fiscal 21, we expect our adjusted pre-tax profit for fiscal 22 to grow between $260 million and $310 million, up 32 to 57% compared to fiscal 21. On the right-hand portion of the slide, we show earnings per share for the past 3 years. Assuming a 30% tax rate, similar to what we saw in the fourth quarter of fiscal 21, our EPS for fiscal 22 is expected to be between 26 $6.50 and $32 per share. Based on yesterday's closing stock price of $107.55, we're currently trading at 4.9 times our trailing 4 quarters EPS and 3.7 times the midpoint of our earning guidance for fiscal 22. Turning now to slide 22. On this slide, we show our debt maturity ladder at the end of the fourth quarter. On July 31st, we paid off in full 1 year early $111 million of our 10% senior secured notes due July 22 at par, and on August 2nd, we paid off in full 3 years early $70 million of our 10.5% secured notes due July of 2024 at a call price of 102 5/8. We believe that we should be able to refinance our currently undrawn revolving credit facility ahead of its maturity in the first quarter of fiscal 23. After that, we do not have any debt coming due until fiscal 26. Given our $426 million deferred tax asset, we will not have to pay federal income taxes on approximately $1.6 billion of future pre-tax earnings. This tax benefit will significantly enhance our cash flow in years to come and will accelerate our progress in rapidly improving our balance sheet. On slide 23, you can see how our key credit metrics have significantly improved over the past few years, as well as the further improvement we expect to achieve at the midpoint of our guidance for fiscal 22. Total debt to adjusted EBITDA has declined from 9.7 times in fiscal 19 to 3.8 times in 21 and to 3.2 times projected for fiscal 22. Net debt to adjusted EBITDA declined from 8.9 times in fiscal 19 to 3.1 times in fiscal 21 and to 2.6 times projected for fiscal 22. Adjusted EBITDA to interest incurred coverage has more than doubled from 1 times in fiscal 19 to 2.3 times for fiscal 21 and down to up to 2.8 times projected for fiscal 22. Turning to slide 24, assuming we hit the midpoint of our fiscal 22 guidance for pre-tax profit, our shareholders' equity is expected to more than double from fiscal 21's fiscal year-end level. As of yesterday's closing stock price, we're trading at 1.9 times fiscal 22's ending book value. This improvement in our equity position will result in our net debt to capital ratio continuing to decline from 146% at year-end fiscal 19 to 87% at the end of fiscal 21, and at the midpoint of our guidance, it is projected to reduce further to 76% by the end of fiscal 22. We expect to continue improving our balance sheet by reducing debt and growing equity. Our goal is to achieve a mid-30% net debt to capital ratio. We expect to continue our trend of improving our key credit metrics in future periods. As we continue to post strong results, we believe we should be able to refinance our debt structure at markedly lower rates and better terms in the near future. As always, we will analyze and evaluate our capital structure and explore transactions to further strengthen our balance sheet and our financial performance. Lastly, we are pleased to announce our board of directors approved reinstating a $2.7 million dividend payment on our preferred stock payable in January 22. I'll now turn it back to Ara for closing comments.
Thanks, Larry. Slide 25. Looking beyond fiscal 22, which we recognize is a particularly strong year, we're preparing for improving our performance in a more normalized housing market. We continue to plan to deleverage our balance sheet and refinance our capital structure with much more favorable terms than we are able to achieve in a difficult period. This should lead to very significant interest savings in the future, helping our performance in a more normalized market. Strategically, we plan to grow the percentage of lots under option further and increase our inventory turnover further. In short, we plan to do more with less. We believe this is going to lead to higher returns on inventory, and that should be the case even in a more normalized market. With our improved balance sheet and focus on greater inventory turnover, we plan to increase our community count. And finally, with all of the above, we plan to continue to operate at higher volumes and grow, allowing us to leverage our SG&A. We have an operating team that is hitting on all cylinders and is poised to go further. We see a path to return to industry-leading performance and growth and look forward to sharing our results in the near future. That concludes our formal comments, and we'll be happy to turn it over to Q&A.
Thank you. Ladies and gentlemen, if you'd like to ask a question, please press star then one on your touch-tone telephone. Again, if you would like to ask a question, please press star then one. Our first question comes from Alan Ratner of Zelman & Associates. Your line is open.
Hey guys, good morning. Nice quarter and nice job exceeding the revised guidance there. I guess first question on that point, I'm curious if you could maybe just talk through some examples of things that you and your team were able to accomplish in October that resulted in the performance coming in ahead of what you, I guess, feared at that point was a worsening supply chain environment.
Sure. As you know, obviously the supply chain environment was just really tenuous in terms of making the huge number of deliveries. We literally had our teams shipping components from one market to another, whether it was garage doors or lights or a variety of factors to make that quarter's deliveries. And it was right up until the last week or so before we had any real guidance as to whether or not we could make it. Very difficult conditions. The good news is that we made the midpoint of our guidance in deliveries and did better in all the other factors for the reasons we mentioned, including the fact that we didn't spend as much as we thought we would need to beat the supply chain problems.
Got it. No, that's great, and appreciate the color there. Second, would love to dig in a little bit to the gross margin guidance for next year. So, obviously it's a very strong pricing environment, and when I look at your guidance, it obviously implies a pretty sharp ramp in margins in the back half of next year. And Larry, I know you kind of walked through the backlog and the fact that you already have some deliveries, third quarter deliveries in backlog, but it would seem like that's going to be predominantly driven on homes you're selling in the upcoming months here. And you mentioned lower lumber, which is obviously a benefit for a period of time, but lumber has, the futures have doubled off of those recent lows in August. So I'm curious, when does that move higher begin to show up in the margin? Is that reflected in the back half margin and you're just more than able to offset that? Or is that something we should think about heading into 23 at this point? Just trying to think through the moving pieces on margin because, obviously that's going to dictate whether you hit those numbers or not, is the back half performance.
So, Alan, the first thing I'd say is that we have, as I mentioned in my formal comments, is we really have virtually all of our homes expected to close in the first two quarters, not only already in contract backlog, but we know what our costs are because those homes, almost every one of them has already started. So we're very confident in the increasing margins that we're projecting in the second quarter. And then as we look forward, we have quite a few homes in the third quarter and a smattering of the fourth quarter already sold as well. We know what our costs are and what our home prices are there, and we've taken into account our expectations and our margin projections for the full year. So we're still very confident that without any further deterioration in market conditions, including cost, we're confident in those margin projections that we're providing for the full year.
Alan, I will add we do have 30 to 90-day locks on our lumber. We've used the current lumber pricing, and that's protected for another almost a quarter's worth of starts. So Again, while we know we have some exposure for the fourth quarter, we also have pricing opportunities. I can just tell you the market just feels really strong regarding pricing opportunities. So we're comfortable. There's always risk, and that's why we were conservative last year, and hopefully we've been sufficiently conservative to deliver some great results this coming year.
Great. Thanks a lot, guys. Appreciate the color.
Thank you. Our next question comes from Alex Barron of Housing Research. Your line is open.
Yeah, thank you, and congrats on the improved performance this whole year. I just wanted to verify if I heard you right that the expected guidance of gross margin for the full year was 23.5 to 25.5.
That's correct.
Okay, great. So obviously that suggests a pretty nice gross margin improvement in the back half. I guess, my question is, at this point, do you feel that those types of margins in the back?
All right, so we'll pause briefly to go over the 5-year trend. Took me kind of a while to get through it. I was kind of having an issue there. Their balance sheets are kind of annoying to work with because they're not actually separating things out into current and non-current assets and liabilities. So I kind of have to make judgments on that myself, at which point then I kind of got confused which items I was counting in which years, and had to kind of double track a little bit. So it took a little bit longer than normal to get to this point, but we are here where we are. Looking at the sales to capital ratio, just as we were saying that the industry in general projects pretty high sales to capital ratio above 1. You can see that they actually pretty consistently have struck well above 2. That's pretty awesome to see. They're even having above 3 in some areas, so a very, very high sales to capital ratio, which is pretty sweet. And then, as I was saying, as far as their multiple goes, you see for 2021 and 2020, they did have pretty cheap multiples. 2020 gets back to a sort of a similar multiple from what we're saying we see for them right now is like 5.5 is what we're seeing right now. They were trading at 4 in 2020, though they've also had negative earnings years, and then also had some weird dynamics between years. They also had a reverse stock split. I think it was in 2018, reverse 1 for 25 split. So there is some oddness going on in the share counting with that, and they were also had a weird tax benefit back then as well. So things kind of look a bit weird in this particular time frame. We'll see what it looks like in the back half of that. Moving up the line up to their balance sheet, you can see that they were talking in the call about how they expect their shareholders equity, or the total equity, shareholders equity, to double over the next year, which would be pretty cool to see. That's definitely a huge problem. Like I said, they had negative shareholders equity. They still have negative retained earnings, but as you see, they've very dramatically improved it in 1 year's time, moving the shareholders equity into positive territory. So if they continue that, the retained earnings will move into positive territory. As I've said many other times, it's not necessarily a deal breaker when companies have negative retained earnings, but it is something that can not be maintained forever. It definitely has limitations on it, so it's good to see them working to improve that. Overall, their liabilities are actually moving down. It is very, very slow moving down. It's only really see a solid movement on it in this most recent year, but it is true. While the current liabilities are technically moving up, so that is something to keep in mind. Technically, they've been shifting their long-term liabilities more towards the current, which is a little bit in contrast with what they were talking about with the laddering of their long-term debt. Though I would say, having looked at their long-term debt, what they were saying about the laddering of it is accurate, and we'll look at a chart related to that when we do some analysis. Their assets over the same period have dramatically improved. Well, not really dramatically, but much more improved than the liabilities have dropped. So on the overall balance of it, that's a good improvement, which is how we get the shareholders' equity movement upward. And then their current assets are also moving up as well. So at least their current assets are moving upward, even though they're not moving up as fast as the liabilities are relative to, or the current liabilities are relative to the long-term liabilities. So that's just one factor to keep in mind. But with the negative shareholder equity for a lot of years, they don't really have a good return on equity number to give us to look at. However, the returns on invested capital are pretty strong across the board, even though they have one negative here and there as far as that overall number goes. But the capital base is very good. Sales to capital ratio is very good. Returns on invested capital is very good, and also their corrected net margin is overall pretty good, though obviously chaotic because of the weird balance of issues that they have in their business. The average over this entire period actually only comes out to 1.72%, so it's not very good in that terms of it, but the large sales to capital ratio I think maybe more than makes up for the volatility in their net income. We'll see how that plays out on net of it. They don't seem to be paying out to their common shareholders at all, so it doesn't really matter too much that they have a negative free cash flow to equity. They're definitely not overpaying their shareholders because they're not paying them at all, but they are technically taking money from their shareholders by having that negative free cash flow to equity. Over 103 million for each year or so on average. So that means that over the 5-year period, shareholders have lost $500 million. Again, their market cap right now is $800 million. And it's interesting because their market cap has actually grown by about $500 million during that same time frame. So that's a little funny to see that technically the shareholders have lost $500 million on this company, yet they've actually piled into it. But I don't know, like I said, that sounds very, very critical. I'm actually have some reasons to be optimistic about the potential for this business, but we'll see what on the overall balance if that actually pans out. I am interested in this company for reasons, but it doesn't necessarily mean that it'll actually pan out well. So we'll hop back into the 6-year and continue the call.
Back half, how many years of land, I guess, do you guys still have at pre-COVID type pricing? Like, does it cover through 2023?
Well, we mentioned specifically we have 5 years. At last year's number of deliveries, we've got 5 years of deliveries locked in land. We didn't comment specifically on what pricing, but last year we had a big chunk of 23's deliveries already locked, so we're feeling reasonably good. I do want to add that the homes we just delivered we generally pre-sell most of our homes, so the homes that we delivered in the fourth quarter were sold before that, a quarter or 2 quarters plus before that. Those were at lower prices. Our prices have been going up quite a bit. That's what gives us part of the confidence regarding our future gross margins. Secondly, the homes we just delivered were at peak lumber pricing. The homes that we've been starting over the last couple of quarters have been at much better prices regarding lumber. So home prices are going up. Costs, or at least lumber costs, have been going down, and that's what's driving our gross margins to increase from where we've been.
Okay, and how about on the first quarter, the low end of that margin guidance? If you're saying the peak lumber costs already happened and we're still seeing higher prices, so what's driving that first quarter homes, the deliveries were started 2 quarters before that. So those still had higher lumber costs. As we mentioned in the call, it's not until the second quarter deliveries where those homes were started at lower lumber prices where you'll start to see the juicier margins, so to speak. Got it. Okay, great. And then on the phantom stock up and down adjustment, I thought that ended in 2021. Am I wrong? Does it go through 2022 as well?
Can you repeat the question?
The adjustments you make to the SG&A due to the phantom stock, do those adjustments continue into fiscal 22 as well every quarter?
Yeah. Yes. What happens is until the phantom stock has been paid out, which 60% of that phantom stock plan will be paid out in January, and then a year later another 20%, and then a year after that another 20%. So it'll be a declining impact on SG&A from any stock price movements, but it's still there until it's actually paid out. The first payout, I think, is mid-January of 22.
Okay, great. And if I could ask one more, so you guys haven't, you've been reporting a lot of orders for this KSA component, but no delivery. So when are those units going to start delivering?
we expect, well, first of all, it's an interesting environment in Saudi, and the sales have been exceptional. We've got a huge backlog, not only backlog, but the customers in that market make big stage payments. Our venture has received much of the cash for a lot of our backlog already. We are waiting until final occupancy, which has some administrative hurdles in Saudi for that to occur. But we're making great progress, so we anticipate that's going to be happening in the next few quarters. But we're waiting on that. Nonetheless, it's not a hugely material number. We're doing very well there, and returns on inventory are great, but it's not a big needle mover in terms of our overall performance.
Okay, thanks. I'll get back in the queue.
Okay.
Thank you. Our next question comes from Jordan Heimowitz of Philadelphia Financial. Line is open.
Thanks, guys. Let me just first follow up with Alex's question on Saudi. I mean, most people probably don't know, but Saudi is having a giant mortgage boom. The government's subsidizing mortgages heavily. Home building is a big part of the 2030 plan. I mean, even though it's not a needle mover now, the visibility and uptick on Saudi home ownership rate is ginormous. And could that be expanded? Are there limits? I mean, can you talk a little bit more about what that could be in 4 or 5 years?
Sure. We think it's a huge market. We think there is a lot of opportunity there. As we said, we've done very well. We've got a lot of experience, and we think we're really well poised to be in the center of that recovery. They have a big baby boom generation in that market. The government has been helping the home buyers with mortgage costs. Housing for their middle class is a big priority in the kingdom. So, again, we think there's a lot of upside and future opportunity for us there.
Okay. Back to domestic stuff. Do your numbers assume any global refinance going on?
No, our projections don't assume any refinance of our debt, though we certainly continue to monitor the market carefully, and we believe in the not too distant future we should be able to convince bond investors to refinance our debt structure at materially lower rates than we're currently paying. None of that's built into our projections.
You're paying an average of over 10% on over $1 billion, and the rate would seem to be sub 7 today, or at least close to 7. So that could be material savings that's not built into your guidance, correct?
Correct.
I agree.
Okay. Final question is, because you're not paying any taxes for the foreseeable future, book value grows with the pre-tax number, right? Not the diluted EPS number, which I think is closer to $40. Again, that's even before the debt savings, correct? Is that the way to think about it?
Correct.
Go ahead.
Correct. I'm sorry, I missed the specific question. Are you asking on a cash basis EPS? Is that what you said?
Well, I mean, you're going to put book value per share, but isn't book value, since you're not paying taxes, you know, shouldn't you add back the tax effect of the DTA to be comparable? You see what I'm saying? Because you're not paying any taxes, so if book value is a measure of liquidation, you're going to earn next year closer to $40, not 26 to 32 by your guidance.
On a cash basis, that's correct, but the DTA is on our balance sheet as an asset.
I don't disagree with that.
Yeah.
But book value will grow faster.
Yeah.
You see what I'm saying?
I agree.
Yes, that's correct.
Okay. Thank you.
Thank you. Again, ladies and gentlemen, if you'd like to ask a question, please press star then 1 on your touchtone telephone.
Man, that guy was
painful.
painful.
Our next question comes from Kwaku Abrokawa of Goldman Sachs. Your line is open.
Thank you so much, and congratulations, guys. My questions were mostly answered, but so I'll just follow on as to sort of what is your anticipated timing of the refi of the revolver?
You know, we don't have a specific date in mind. Obviously, it comes due, I think, December of 22, so sometime this year. December 22. So sometime this year we'll address that, but given that it's the tippy top of our capital structure, it's the least of my concerns on being able to refinance that at this point.
Thank you so much for that. And just as a follow-up on that, is the refi of the capital structure, the refi of the 2026 maturity wall, contingent on refining the revolver at all, or are those two very distinct issues?
I think they're two separate issues.
Appreciate it. Thank you so much, and congrats.
Thank you.
Thank you.
Thank you. Our next question comes from Alex Barron of Housing Research. Your line is open.
For taking my follow-ups. So I noticed in your slides that the November orders were down 5% year over year, which is a very solid improvement versus the last couple quarters. So is that indicative that you guys are not, holding back sales as much anymore? That things are kind of caught up a little bit more, or how should we interpret that? And also, is that number roughly across all the markets, or how does that playing out?
Well, first, I'll reiterate that we're actually up 10% in dollars, but we do continue to meter sales in many of our communities. Construction is pacing on a metered way in many of our communities, and we're metering sales to match that.
Yeah, I think the short version, Alex, is the market continues to remain very strong, and demand for new homes remains strong. It's not at the white-hot pace that we saw in the fourth quarter a year ago on a per-community basis, but demand remains very strong across really all of our markets.
Right. So, I mean, I guess if we look at last year, it would seem like the only tough comp you guys have ahead is 2 months from now. I guess that would be January. So
I think the market slowed to a more rational pace starting in May last year, calendar month of May. The spring selling season, I would still say, was pretty hot from the COVID surge. And that, pace per community began to slow to more rational pace in May.
Right. Now, you guys made a comment that you don't build so many specs, I guess, compared to other builders. But, even many companies that traditionally didn't build specs have kind of switched in the current supply chain issue environment to building more specs. So I'm just kind of curious if you guys can comment on have you guys adjusted your strategy, or is that something that's in process, or are you just going to continue the way you always have? And can you elaborate on that decision?
We haven't really changed our strategy. We have about $2 billion of backlog. So we are focused on starting those homes. We do build some specs, but it's not the predominant part of our strategy. And at the current time, we're not planning on shifting that.
Got it. And if I could ask one more on the refinance issue, is the only thing that is holding that up basically that you guys are waiting to get the rate you're trying to get? Is that the only main thing, or is there anything else?
No, that's the primary issue. Our current capital structure is pretty unusual, and many of the slices of maturities, don't have a lot of liquidity to them. They're small in size, so they're just not actively traded. So we have been educating bond investors about our improved performance, and educating the rating agencies about our improved performance. And as the market recognizes our improved performance and is willing to give us rates closer to what similarly situated home building peers have gotten, we'll pull the trigger. But we don't have a gun at our head because we really don't have any material amount of debt coming due to 26. So we can afford to wait. But we think we've made good progress in that educational process that I just described, and we're optimistic that we'll be able to do something in the not too distant future.
I will add, we do have a substantial reduction in our call premiums in February, so that certainly plays into our thinking.
Now, I appreciate everything you're saying, and you guys obviously have made a lot of progress. But does this have to be like all or nothing, or could it be done in stages, or is there something that prevents that? In other words, can you just take one issue out at a time?
There's nothing structurally that would prevent us from that other than size. Some of our current issues are pretty small, so I don't think you could do it an issue at a time, but you still could do it a chunk at a time to get to a liquidity size, call it $400 million plus or minus, that the market probably would want to see to really have strong liquidity in a new issue. So we wouldn't have to do everything all at once. We could do it in steps, but I don't think we could do it, each individual issue that we currently have couldn't be refinanced easily.
Got it. And lastly, I know last year or this year, fiscal 21, you guys reversed most of your DTA, but there was some portion that was not reversed. Is there any update on when that might get fully reversed?
Right. It's likely that won't get fully reversed. The reason that's still reserved is that's 8 NOLs in states that we don't have a lot of operations remaining, for example, Pennsylvania or Illinois. And so at the current time, we don't anticipate being able to use those, and that's why they're still reserved. If that changes and at some point we can anticipate generating profits in those states, we would consider or would be able to reverse it. But at the moment, we don't anticipate that occurring. And then once the time runs out for those NOLs, both the asset and the reserve would just be written off.
Having no net effect on our books because there's a reserve. Yeah.
Right. Understood. Okay. Very well, and congrats and best of luck for this year. Thank you.
Thank you, Alex.
Thank you. Our next question comes from Vincent Foley of Barclays. Your line is open.
Morning, guys. Thanks for taking my questions. A couple more on the balance sheet. Larry, I think you talked a little bit about looking for the right rate to do a refinance and something similar to your peers. Should we read that to mean that a secured debt issuance is not what you're looking to do here, which would clearly come with a much lower cost of capital, and it's your intent to take the capital structure and make it essentially all unencumbered?
Vince, I don't think we have any hard and fast line that would say we wouldn't do a secured deal if that was the most advantageous way to proceed. We think we deserve to be able to refinance on an unsecured basis. It may take 2 steps rather than 1 step to accomplish that. So we're not ruling out doing a secured refinance, but at the same time, we think our credit warrant our ability to do it on an unsecured basis. But we'll just see what the market will accept.
That was helpful. Secondly, I think it's on page 24 of the deck, you talked about a mid-30% net debt to cap target, which is clearly optimistic given where you are right now. Can you kind of walk us through what sort of a time frame we should think about here? And, how do you get there? Is this strictly through growth in your equity, or, how should we think about like a longer-term targets for absolute debt balance here?
Well, since you're looking at that slide, we took it from 146% to 86% in a couple of years, so that's a pretty significant improvement, and we're projecting to get to 75%. So, we really cut it in half in just a few short years. So I don't think it's going to, take forever for us to get to a mid 30% debt to cap. So although it's not a next year and maybe not a year after that kind of thing, it isn't 5 or 10 years from now that we're talking about. It's nearer term than that. But we don't have a specific time frame. We're going to do it through a combination of continuing to grow earnings and which will enhance our book value and combine that with continuing to reduce debt. And those two things together are powerful tools on improving our balance sheet and getting us closer and closer to that mid 30% debt to cap goal.
As I think was discussed during the call, our cash flow is better than our reported net income because of the NOL. So that really enhances our opportunity to reduce debt more than the growth in book value coming up might imply.
Thank you. I certainly didn't mean to imply that it wasn't impressive. Certainly going from 150% to where you're going to be next year was pretty amazing. Two more for me. As part of any potential refinancing transaction, any consideration to doing an equity raise alongside?
Well, at the current time, we're not contemplating that. We always look at everything, but we're pretty optimistic about our earnings outlook. We think our stock is selling at a pretty low multiple of this year's earnings, let alone the earnings power with a more improved balance sheet and financial foundation. So at this point, while we always consider everything, that's not on our front burner.
Okay. And last one for me. Your rationale behind starting to pay a preferred dividend again, and why not use some of that cash to delever even further?
I would answer it this way, and that is that although covenants for the last 15 years or so have prevented us from paying that preferred dividend, so we had no choice in the matter. We were prohibited from paying it, and it was a non-cumulative preferred. I think we had a moral obligation once covenants no longer prevented us from paying it to actually reinstate it. And so once we were able to see that our credit statistics had improved, that would allow us without violating any covenants to pay it, and we can look forward and say that we're going to continue to have strong performance. We're just the type of company that we issued that preferred debt and promised to pay it, and we're going to honor our obligations, even if we may not have been absolutely legally required to do it. We still think that we were morally obligated and happy to reinstate that dividend for our preferred holders.
Okay. Thank you for your time.
Thank you. Our next question comes from Jordan Hamowitz of Philadelphia Finance. Your line is open.
Thanks. Two quick follow-ups. One, I want to follow up on the last gentleman's question, because I actually think by putting that cumulative preferred, I think it substantially improves your ability to issue debt at a much lower cost, because I think it shows the integrity that you guys have. I mean, it shows that a bond investor knows that even if things get tough, you guys are not going to try and not honor your obligation. So I compliment you dramatically on that, on the ethics of it. The second thing is on the preferred. A preferred today has a much lower coupon than 7.5 thing. Is that ever callable though at par, or hypothetically might that continue to trade up through par because the comps are trading at much lower yields?
I would the real honest answer to that is I just haven't thought about it or looked into it. So I don't have a great answer for you in terms of what the preferred might trade at. We just reinstated it, and we just haven't spent any time thinking about that aspect at this point.
Is it callable?
I don't know the answer. Brad, do you?
I don't, off the top of my head.
Yeah, we'll certainly look into it. We just haven't been focusing on the preferred. So unlike all the rest of our debt, we could tell you off the top of our head the answer to most questions on the preferred. We would happy to get back with you, Jordan's a real answer.
Fine, and just to make sure I'm doing my numbers right, if your guidance is 26 to 32 next year, but if you tax effect that, that adds another 25% on top of that, and then if you hypothetically did a 7% versus a 10+% debt refinance in February, you'd be earning north of $40 per share in cash earnings next year. Is that generally correct?
Yeah,
Brad, you want to tackle that one?
I can't check your math that quickly, but what you're trying to do directionally sounds correct.
Okay. I mean, at 3 times earnings, it's definitely the cheapest home builder in the group, and book value grows very quickly.
I don't think there's any other home builders that grow as rapidly their book as we've been growing our book, and I just don't think the market's fully appreciated that, nor do I think certain analysts have appreciated that.
And we certainly agree, and that's part of why we answer the question regarding any potential equity offering. We think we're still a really, really good value.
Last thing, is there any rating agencies evaluating their ratings at this point? I mean, who knows what they're going to do, but given the improved cash flows, when is the next time that someone's looking? Because if there'd be a rating upgrade, it would clearly help the ability to raise capital as well. That capital.
That's a great point, and we certainly plan to have conversations with both rating agencies in the very near future, as we promised them previously we would after we reported earnings.
Okay, thank you.
Thank you. Our next question comes from Kwaku Abramova. Goldman Sachs, your line is open.
Yes, this just 2 follow-ups. A quick question on your attempt to refi. What is the biggest pushback beyond the rate that you get? Is it your attempt to educate new investors on utilizing debt to EBITDA, or some of the newer metrics, almost like the EBITDA metrics, or versus the more traditional metrics of net debt to capitalization, which is high, but as you said, it's gonna come down over time as you accrue value. What are the biggest pushbacks are you getting in terms of the investor education?
I don't think we're really getting pushbacks. I think it's more a rate issue. I think that we could have refinanced our debt 2 quarters ago. We just haven't liked the rate that the market is telegraphing that they would do, but it continues to get better, and I'm optimistic we'll be able to refinance.
Yeah, as we mentioned, call premiums drop substantially in the coming months, and we are eager to show the performance, and we feel very good about our upcoming performance, let alone this quarter's performance. So we think all of that will play nicely to our opportunities for refinancing.
Perfect. And just one last follow-up on the preferred dividends. Does the covenants also apply to common stock? But can you institute a common stock dividend at this time, given the covenants?
Let me answer it this way. In the history of the company, as a public company, we've never issued a preferred dividend. We went public in the early 1980s. It's just never been part of our strategy. But I do not believe there's anything that would prevent us from deciding to issue a dividend on our common stock. But I would say it's a safe bet until we have a much stronger balance sheet that we have no intention of declaring a dividend on our common stock.
Perfect. Thank you so much, guys. I'm sorry, go ahead.
No, I was just going to add that we do want to de-lever, and that's very high. Plus, we're earning very high returns on equity. So dollars and remaining in the, that are reinvested in the company, we're earning some good returns on that. So that's part of the reason for not focusing on dividends to common right now.
Thank you so much. Take care.
Thank you. I'm showing no further questions at this time. I'd like to turn the call back over to Ara Hovnanian for any closing remarks.
Thank you very much. As we said, we're pleased with our results, but we're even more excited about the quarters to come in fiscal 22, and we'll look forward to reporting them. Thanks so much.
This concludes the conference call for today. Thank you all for participating and have a nice day.
Okay, well, like I said, I kind of came in a little bit slower on this particular set of financial statements. It's a little bit complicated, and that's taken me a little bit longer. But luckily, we got to the end of the call. We don't have too much more work to do. Finish up these last 2 years. Make sure I get all of these things. And that should be it. 17. There we go. Okay. Alright, now the liabilities. No current debt really, other than the accrued interest, other than ways in which they specify it. So that's one of the things that makes these financial statements difficult. Is like, I know I already mentioned it before, they're not sectioning off anything in their balance sheets by current or non-current. And then they also have many of them sectioned off between financial services and home billing. So it's almost like looking at 2 separate balance sheets and having to put them together, and then also re-split them apart by a different setup. So it's been a little bit of a pain. And then every year or two it kind of shifts as well, so it doesn't even stay consistently the same setup across all 10. But we're almost done. Okay, get those. Income taxes payable. It's all the payables. Payables would definitely count as short-term. Liabilities that are short-term, they're non-payables, would be like customer deposits. Okay, so that should be all the currents. And then long-term debt. We are including warehouse lines of credits because we don't actually know how long the terms are for that, so we have to assume that it's longer. See, that's how this becomes a little bit complicated. And then the leftover. Is there anything left over on this one? Maybe there's nothing left over on this one. 2191, 2191. Okay. Luckily, the shareholders' equity isn't that complicated. You do have to add the preferreds to the B class shares, but that's fine. And then other than that, it's pretty straightforward. Okay, now the last year. A little bit separated off. Total revenues, costs of revenues. SG&A in both categories, plus other operation expenses. For interest expenses, we include all the financial service expenses plus other interests, and then we also net out the gain or loss on extinguishment of debt. Other non-operating incomes, we count the unconsolidated income or loss, then total tax expenses or gain from tax benefits. $6.192, yeah, so you can see the income statement's not too difficult. I had a little bit of the first year or two, but once I found the pattern for that one actually stayed relatively consistent. The cash flow statement is also relatively consistent, even though it is a little bit messy. Just one item for the non-cash payables, and then the working capital ends up being actually the vast majority of it. Their capital expenditures, so it's kind of hiding in the operating cash flows, which we do want to include the net gain for the unconsolidated ventures. You can see there's a positive and negative one in every single cash flow statement, which means we want to include them because that means that there's a balance on the cash flow difference. And then also all of the increase in assets or liabilities in the operating line, which as you can see across most of the years is actually way larger than the capex, so whether positive or negative. So that's actually the vast majority of the capital expenditures is in operating cash flows, but we do have to net out the investing cash flows as well, which includes unconsolidated joint ventures. And then the net debt, which is also a very complicated mix of stuff, which a lot of times I'm very selective for different companies about some of the things that I include for this, but it's because of their weird complicated capital structure, I'm actually including basically everything in this company's finance section, because they just do have a whole mix of stuff. Oh, here's the first time we see actual stock issuance and treasury repurchases, which is interesting. So we'll net those out as well. Okay, as you can see, their cash flow has been very messy. So now we get to the final balance sheet, which is a bitch every time. See, so cash plus also the cash in the financial service section. Receivables, we're going to include these receivables. And then for the inventories, we are not going to include everything they count as inventories. We're actually only going to include the sold and unsold homes, but not the options. Options we're going to call long-term. Current items, we're going to include the restricted cash in both categories. And then this is also the other short-term assets. So we'll include all the other assets from the financial services. We don't really know what those are. And some of them could be long-term, but it's relatively small, but in the financial services, we're going to count those. And then in plants and equipment, we include that, but that's the simpler one. And then other assets is everything else, which incidentally includes the options plus the investments in joint ventures. Oh, I forgot the prepaid expenses. But and this one also includes mortgages for sale. And then the prepaid expenses actually goes with the other current. So I missed that one. Okay. Wait, what was the total? 1684, 1684. Okay, so then on to the liabilities. No specifically set current debt other than the accrued interest, so we'll put that in there. Payables, all of these things not including the customer deposits, plus the financing payables, plus the income taxes payable. And the other liability is the customer deposits. Then long-term debt will include, like I said, the warehouse lines of credit, plus all the notes payable. We already counted the accrued interest. And that should be it. What was the liabilities? 2169, 2169. All right, then on to the equity, which is pretty easy, as I've said. Okay, so then we can get into kind of thinking about the business itself after I finish this up. Hopefully I can get through the rest of it relatively quickly. The stream is, like I said, going a little bit long because these balance sheets were just a pain in the ass to get straight. Okay, so here's the full 10 years. Let's go ahead and take a look at what we got. Going back down to the sales capital ratio, looking at the trend for the previous 5 years, it does look like it was a little bit lower on average in the previous 5 years, but still well above 1 in every single year, as you can see. So this kind of balance between 1 and 3 overall over the very, very long run. It's a very, very strong gain. I'm sitting here about 2.21 on the average overall. As you can see, they've traded pretty much all across the board as far as multiples go, but they've traded pretty cheap in the past, also pretty expensive, but also they've had negative earnings in several years, so that's a little bit of a strange back and forth. Taking a look overall at the balance sheet changes, again, they've had positive total shareholders equity in the most recent year, which is the only year they've had in those 10 years. However, they did have a pretty high negative returned earnings throughout the entire period, as we had already discussed. So the fact that they've shown pretty significant improvement in the most recent years, I think, is a pretty solid sign. And then as far as the liabilities go, you can see that actually the liabilities are basically flat over the entire period, with total assets still actually improving on net, which is where that shareholders equity improvements came from. Taking a look at the total current liabilities, those actually did grow over the period, which is in line with what the trend we had already seen. And then the total current assets are also growing over the period, but not as quickly as the current liabilities. So that's sort of where the trade-off is. They've grown their assets while making a trade-off on long-term liabilities for short-term liabilities. And that's on the overall set of their liabilities, not the debt maturities, which we'll get to. Return on equity has been a total mess across the board because of the negative cash neutral shareholders equity, but the returns on invested capital have been pretty strong across the entire period in general, even though there's been some negative years mixed in there. Overall coming to really, really high levels. Unfortunately, the way my formula works with companies that have negative cash neutral shareholders equity, it kind of ends up with a little bit of a default generic thing where I take the most recent year and just cut it in half. So that's actually the scenario that we're looking at right here. But on net, the average number over the entire period actually comes to 16-17%. So we'll see what we look at on the balance for our projections. Free cash flow to equity over the entire 10-year period comes to negative 37 million per year. So this has definitely been a cash burning company as far as the common stock shareholder goes, but that's not really too surprising compared to everything we'd already seen. Looking at the long-term average of their income margins, it's definitely basically only about 2% margin if you include all the lost years on net. They do have revaluations on their inventory, which causes the deferred tax issue that we saw in the most recent year. Though in the earnings call, they were also talking about the like 1.5+ billion dollars in net operating losses, the carry forwards they have, and it does sound like they're going to be using a lot of those in the near futures to make sure their cash flows move up into higher levels, which is going to help them delever. So we'll see on terms of that. Looking at their revenues over the entire period, they do have pretty strong revenue growth, pretty strong double-digit revenue growth in a lot of the years, though they've also had double-digit drops in their growth as well. On the overall period, you can see that over a rolling 5-year period, it's been a pretty solidly positive time, except for a one negative dip period right here where it does look like they had a pretty solid bad 5 years on net. And then as it rolls forward, it kind of becomes a little bit of a balance out. So it's been balanced for the last 5 years, and then it was strong growth before that, essentially speaking. Though they do have some projections for growth moving forward. So getting into a little bit of everything else, pay no attention to this price. We still have a lot of things to look at and to adjust. None of these numbers are adjusted for all of our expectations. Going straight down to the bottom, we'll take a look at the cost of equity. Holy crap, that is fascinating to look at. Okay, so I mean, I already said that I was expecting this to a degree. With an unlevered beta of 1.11, and they have a really high leverage level. It turns out our calculations brings them to about 150% in debt to equity ratio, which according to the leveraging formula, this needs adjusting because it's going to be including this tax rate. So that's part of the reason that we have that number in there. So like I said, never pay attention to the number that first appears when we pull our projections out, because some of these things are based on parts of the formula that assume certain things are operating at a normal level, which this tax rate thing being one of them. So, which is why we very often have to make kind of manual adjustments to what we think is a viable tax rate. We do actually have to make this tax rate really, really low because of the fact they do have those operating carry forwards. Technically, it should be negative for the next 5 years, but we can't have this number be perpetually negative. So we have to assume that it at least goes positive at some point in the future, even though it could remain at a relatively low level. We'll just leave that there for now. So going back down to the beta, that brings the ridiculously absurd levered beta of 6 back down to a little bit more rational of a level of 2.69%. 2.69% brings the total cost of equity up to 15.17%, which might sound a little insane to have a discount rate of 15.17%, especially when most of our discount rates fall between like 5 and 9%. But you do have to keep in mind that what they also discussed on the call, which is our interest rate. Our book interest rate comes out to about 9.5%, and over a 3-year average period, their interest rate seems to sit about 10.192%. So that seemed to be in line with it. They have a very, very high interest rate. They were talking about this and in those last several calls. Questions were about trying to drop their equity ratios and laddering their debt rather well, which they do have a pretty good debt ladder. We're going to get into a little bit of their presentation. So the cost of equity obviously has to be higher than their interest payments that they're paying. Otherwise, there's no incentive for people to own equity over the debt. So that is where the high discount rate comes from. As far as projections for the future go, this is extraordinarily low, so that's probably one of the reasons this number up here is really high. Before we do get into some of those projections, I do want to actually go into their little presentation thing, and we're going to talk about a few things. They do have this very nice presentation, which includes a lot of very, very useful information, including showing a lot of stuff about their backlog is up rather high and overall the liquidity positions. But some of their projections for the future were very interesting to me as far as their long-term look. They did provide, as I said in the call, guidance for both the first and second quarter of 2022 as well as full year, showing that their guidance for revenues is between $2.8 and $3 billion or so. So that gives us a little bit of a line to expect. And then they gave us the diluted EPS, which excludes valuation allowance reductions, which we can assume that that's going to be relatively low. Other than most recent year, most years, that's a relatively low number. So this should be relatively close to the GAAP EPS number, which puts them in line for essentially about an EPS of, or they're about a multiple of like 5 to 6 of their 1 year forward EPS. And then showing their guidance range of their revenues over the last several years, and then their projection expectations for that, as well as for the pre-tax profit and the EPS numbers. But the housing market expectations I thought was very interesting as well. They have the affordability index right here, which shows like whenever the chart is really high, that means housing is relatively affordable comparative to previous years, re-indexed backwards, showing that yes, the affordability right now is actually much better than it was during the 80s or 90s according to them. That has to do with low interest rates and therefore low mortgage payments regardless of the high home prices. Though you can see it's been dropping for the most recent year or so, which has to do with the rise in the home prices themselves. And then also talking about how this is an opportunity for them because there's actually a huge backlog, what with a lack of housing production caused in the last 10 years relative to the past. My argument to kind of backtrack against that is that the home supply numbers are actually back up to where they were or back above the long-term average compared to where they were in the drop since 2020. So it's something to keep in mind, though this is also in the winter spike. October numbers is the most recent numbers we have, and you can see in previous years it's always this winter time frame when this upward spike comes. So it is worth noting that we're technically at the peak of the section, so maybe like a midpoint of the spike is actually maybe about where our real average currently is, but that does mean that perhaps the current home supply is not actually as bad as a lot of the forward projections are on that. So just things to kind of keep in mind. They have a lot of data kind of going further into some of these things and even some of the similar charts. But so as we make our projections, I kind of want to keep those factors in mind. So we'll kind of put the debt ratio into a slightly more appropriate place before we make some of the other projections, since this is probably going to make a huge effect on everything to do with this valuation. $834 million market cap. So let's assume that they lose half their market cap and drop down to $400 million market cap with $1.2 billion. We can also assume that they perhaps take on a huge amount more than that. It's actually pretty easy to assume how this debt to equity ratio could pretty dramatically turn into 400 or even 500%. So we're actually going to throw that number up there and watch as that number drops rather dramatically, because that actually turns our cost of equity under those scenarios into some pretty absurd levels. So let's see where that brings our on net ratio unadjusted for the probabilities, which brings us to 173%. So we're a little bit closer to where it sort of needs to be. Best case scenario, there's basically no way in hell that they're going to bring it down to 0%, but let's assume that they double in market cap and also manage to trim their debt back by maybe about a third. So that would bring them to 1.6 billion with their debt perhaps dropping to 80 billion. That could bring them perhaps to 50%. So I could see 50% perhaps as like a best case scenario for them. And then maybe an analyst number, we can put a sweet spot on maybe more optimistic side. 100% could be a viable number. The net number that brings us to 200%, I think that's a little bit too high for the expected value even before adjusting for probabilities. So let's maybe be a little bit more gracious to them in the worst case scenario. We can also be a little more gracious to them on the best case scenario because of the assumptions that the market cap could make even more dramatic jumps than that. So I could even drop it maybe to like 35 or 30% as a best case scenario under those assumptions, and then also drop this, like I said, maybe to 300, 350, depending on where that leaves our number right here. We'll maybe leave it at 300 right now and then be willing to adjust it a little bit further if necessary. So that brings us to that level. We can move on to some other factors. Let's go with the sales capital ratio next, because I know that needs to be jumped up rather dramatically, because over, like you can see, over the long run period, we have 2.21 as sort of an average. So let's put our expectations in line with those types of numbers. Maybe, like I said, between 1 and 3 seems to be a pretty fair band of area that they've had over time. We could pretty much just leave that in place. That actually didn't really affect the value too much. So we'll leave that there for now. We might adjust it a little bit more in a bit. We're going to kind of adjust these things piecemeal. Taking a look at our current returns on invested capital expectations, that brings us to that level, but that's with the margin and revenue assumptions we currently have. So we have some things to think about as far as all that goes. Now, revenues, this part is where things do get a little bit complicated. They do have pretty solid revenue expectations for the next couple of years. As we were talking about, they seem to believe that this next year is going to have some solid revenue on it. I could have sworn this company did have analyst numbers for the revenue numbers. I guess I was mistaken on that. Must have been one of the other companies I was looking at. But so the point is if you look at, like I said, the revenue numbers, they do tend to have either pretty large numbers one way or the other. It tends to be either a large pop in revenues, or it's a decline in revenues, or it's basically relatively flat. It's not a very stable type growth of revenues. And they have had pretty good growth in the most recent 2 years. So I do want to assume that there's a pretty good chance that they have revenue declines as a result of that. Obviously, they can have some pretty large declines as well. And plus the type of industry they're in and the capital scenario they're in, we kind of want to leave some pretty neutral assumptions. So negative 10% to perhaps 12% does lean still more towards the optimistic end, and this is still with a pretty neutral set of revenue assumptions. We can put this more towards the midline between the median and the optimistic end of things. And like I said, we will perhaps adjust the probabilities a little bit. Or even maybe I'll even just leave this at 10% and then adjust the probabilities a little bit more strongly. I don't know, maybe even something like that. That leaves the revenue expectations at like 1.45% while leaving pretty solid room for solid revenue growth. You know, if I'm going to lean more towards the optimistic end of things, maybe you could argue that I don't need to have as optimistic of a of a revenue number. You could even leave it at something like 8, because if you look at the overall COGR, they've had this one period of 5 years where they had a 10, 11-year COGR, and you could also argue that this is ready for a bounce back, that these couple years right here are in preparation for a larger bull run of revenue growth for them. But with the things tilted this way, you could leave it with those assumptions. But also, the negative 10% was a little bit of a overly pessimistic number. You could argue that the lack of, maybe the extremities should have been chilled on both ends of it, and this brings the expected COGR back to 1.25. Taking a look at what the change in the probabilities did for our debt to equity ratio, that brings the debt to equity expectations to 162%, which is relatively in line with where it currently is. Like I was saying before, we could still maybe adjust this to like 300%. That was maybe a pretty extreme value, which brings the expectation to 144%. I think that's a pretty fair assumption given their actual plans for deleveraging. But I don't know, we can, for the sake of conservativeness, we could also leave the 350 in there. This is a pretty highly leveraged play, and that's a lot of the risk associated with it. We'll see what the default risk is going to do to this. That's the real question. It's like we may have a lot of returns up here for the time being, but what happens after we adjust it for defaults? That's going to probably shave off quite a lot of the value. So getting into the margin expectations, this is definitely where things get a little bit tricky, because they have, well, a pretty wide range of margin potentials. It's like you could leave a pretty wide band of opportunities as far as that goes. Something in this range, I mean, I don't know. Technically, whenever you leave something negative, it kind of throws off the formula a little bit. So it's like when you use an extreme value, you kind of want to necessarily leave at least. If you're gonna have one of them perpetually negative, it's obviously going to be basically valueless, other than residual value that may or may not exist 5 years later. So you want to make sure that at least all the rest of the values remain positive, even if it is a relatively low number. Now, we do have to keep in mind that we did tilt the probabilities pretty heavily towards the optimistic end of things, which is kind of the point. We don't really want to assume the company is going to move into negative territory perpetually without leaving rooms for those optimisms, but we did leave a lot of the optimism on this end of it. So we have to think about how plausible we really think a 7% perpetual margin is. Now, I mean, taking a look, for example, at their interest expense, they have $126 million in interest expenses right there. They're talking about trimming that down to maybe 7% or so. If they were to do that, obviously that could be a pretty decent amount of savings for them. That's easily perhaps $45 million right there. Looking at where their typical net income sort of stabilization area was in 2020, which was a little bit closer to a more normal number that doesn't have the weird revaluations on it, was like 50. It was a relatively low income tax rate, so we assume it's a little bit higher than that. $40 million is almost arguably a fair normalized net income for them. So being able to essentially double their net income simply by trimming their interest rate 7% shows a large room for margin viability. The margin in that particular year was 2%, so that means that 4%, I'd say, is pretty easily achievable just by getting their interest expense trimmed down to 7%. That's not even lowering the leverage, that's just trimming the interest expense. So I would say that getting to 4% is actually pretty viable, with the large opportunity of getting to 7% over the long run is also pretty viable. So I would say that this range is actually more fair than it perhaps seems. This number, normally I actually leave it a little bit higher than the mean case, which means maybe I would adjust it further. That brings it 475. It's like maybe I would trim this slightly. I don't know. I feel pretty okay about that, because like I said, there's going to be other things we're going to do as well. Where that leaves the implied return on invested capital is at 11-12%, which is interesting to see. Like, what was it? I can't remember. The average over the 10-year period came out to 16 to 17%. So the idea that it's a little bit lower than that on our projected numbers, I think that's pretty reasonable. That makes me feel a little bit more confident about the margin expectations that I put in place. You could, like I said, you could argue that perhaps the revenue assumptions we put were too mild overall. In fact, because there is a pretty large amount of weight on the assumption that there's going to be negative revenue growth. So you could argue that this should be a little bit higher, which does make pretty significant changes to the valuation. It's like maybe I would trim this back, but push the revenue assumptions up a little bit more to around 2%. Yeah, see, that feels a little bit better. While leaving this a little bit closer to 4. And then, like I said, the 300% was perhaps a little bit of a large assumption. Bringing it down to 300 brings our expected value to 144, which is really not that much of an improvement. It can be done just by the market cap maintaining a little bit of a higher height when them not even deleveraging. So that's a pretty large improvement. And that has to keep in mind. It's like the fact that we're weighing in that these outcomes mean that it's like incremental improvements on the margin actually have pretty dramatic effects on the value increasing here. This is very much a leverage play. So that's just another thing that you have to keep in mind, is that the potential around the stock has to do with all the ways that deleveraging affects them. By deleveraging, they're lowering their discount rate, but they're also improving their margins simultaneously. You see, and it's already a high quality business that if they had low margin, like if they didn't have a whole bunch of debt, this would be a cash flow machine, this business. And it's just that, like I said, a huge amount of that cash is poured out into debt, high cost debt at that, which also means that their equity is even higher cost. So I feel pretty comfortable with that assumption set. We could probably push this a little bit higher than the 2 because it put it in the mid-range, and then it also brings the expected value to 2.14, which is a little bit higher. So give them a little more break in the sales capital ratio. That is their strength, is the sales capital ratio part. That's the metric where they're like purely good on. So anyway, I think that brings us to the default risk, which is where we're going to shred the value of this company down. Definitely. I can already see that that's where we're headed with this one. It's part of the reason I'm trying to give them a little bit more grace before I do that, because it's definitely going to be brutal. Let's see, any other way that I want to give them slightly more benefit. Maybe bring this down to -7. That brings it to 2.5%. Okay. It feels difficult. It feels difficult assuming too much higher than this. I could see it getting to 5, sort of. Like I said, it's so easy for them to get to 4%. That's the thing. It's like a sustainable 4% margin is so easy for them to achieve. But there's just the risk associated with it. What does changing this to -1 do? Is that gonna... It's not too big of a boost. It's a little bit fair still, because it still leaves the assumptions in range. Okay. Okay. I think we'll do default risk now. There's no other. There's no avoiding it. Time to shred this this valuation down to its very last atom. You know. Okay. Oh well, let's take a look at what their end case debt's gonna look like. No, we can't argue that they'll pay it off. Okay, so in the analyst case, we have 1.72. Oh boy, this is gonna be rough. $2.46. 4.05. Oh, wait. Okay, well, actually, that didn't shred their value as much as I thought it was going to. They're still technically a value, so there's that. Good for them. Good for them. I totally thought it was going to be worse than that. Okay, so that pretty much does it for this valuation. Like I said, this one took us a little bit longer than normal. Those income statements were very difficult, and there was a lot of messy things to kind of think about as this one. And I was just a little bit distracted at the start of the stream too. But yeah, so that's it. Ticker HOV, Hovnanian Enterprises, American home builder. U.S. Treasury is selling for 1.793% today, with a mature market equity risk premium 4.98% currently that I get, and I get a discount rate for this company after adjusting for company-specific idiosyncratic risks of 15.17%. So pretty dang high discount rate. They have no dividend that they pay out. 5 years ago, they had sales of $2.7 billion compared to sales of about $2.7 billion today. So about 0.22% sales growth per year for the last 5 years. Their sales to capital ratio is 2.21 over a 9-year average long-term period, compared to industrial expectations we have of 1.68. So they do have a pretty high sales to capital ratio, and they've achieved pretty high returns on invested capital in the most recent year as a result of that. They have an extraordinarily high debt to equity ratio of about 158%, which I actually didn't put it down their default risk in the most recent year, but their default risk, let's see, what was it? 1.71. Okay. So the default risk in the most recent year was 1.71%, which anything I consider higher, more than 1%, to be pretty significant, because that's actually the default risk for each individual year. And then the profit margins over I think that's the 5-year average, is also incidentally about 1.72%, which is relatively low compared to industrial expectations that we have about 13%. So they're really high. The really high leverage levels in general makes their profit margins very chaotic and very volatile. Their profit in the most recent year was $608 million, partially due to deferred tax inventory revaluation charge that was negative, that brought their earnings into a very large positive territory. They have a current selling price of $119.86 per share. The probability distribution that we use for the stock is pretty heavily tilted towards our optimistic fourth model, which we have revenue expectations of anywhere from $1.9 billion to possibly $4.4 billion, with an expected value of $3.2 billion in the 5-year forward period, which gives sales growth of anywhere from -7% to possibly a positive 10%, with an expected value of 2.58% for the next 5 years per year. The sales to capital ratio we have on an expected basis for 5 years forward is 2.14, so a slight decline in that we're projecting, which would give them returns on invested capital of around 11 to 12% imputed overall, which is still pretty strong, though much lower than the current most recent year. We do project that their debt to equity ratio will compress down to about 125%, but we do actually have projections across our model of anywhere from 250% to possibly 35%. This is mostly a leverage play, so their ability to rein in their debt to equity ratio has a huge effect on their overall valuations that we have as an overall potential. So this is a very widely varying number and important variable in the valuation. As a result of that importance, the default risk that we have projected over the 5-year period is unfortunately extraordinarily high, about 5% per year each year for the next 5 years, though that is heavily tilted towards the worst case scenario outcomes, which, like I said, this whole play is entirely revolving around how they manage their debt. If they manage their debt well, the returns will probably be extraordinarily high. If they don't manage their debt well, they'll probably be pretty bad or meager at best. The profit margins we project for the company is tied to that exact same issue that we've just brought up now twice, which is that we have a profit margin expectation of anywhere from a -1% perpetual profit margin to possibly 9% on the high end, with an expected value of 4.65%, which gets us a profit expectation distribution pretty wide as well. On an expected basis, we see perhaps $161 million, which, with the discount rate that we're using, brings us to a present value distributed price expectation of $131.06, which is 9 to 9.5% higher than the current selling price. We have 5-year forward value targets, unadjusted for any dividends that they could pay out during the period, of anywhere from $0.81 per share to $986.31 per share, which is possibly one of the widest ranges of 5-year forward value targets I've had on any stock ever. But either way, the expected value that we have, again, unadjusted for dividends paid out, is $265.59 per share, which compared to the price it's currently selling at, gets an implied return for the next 5 years of 17.25% per year. So that's a pretty decent return. A reasonably decent quality business. It's just heavily debt laden, and whether or not it's well run is kind of uncertain at this point. Depends on how well they manage that debt, I guess. And it's also worth noting, though, that 17.25%, well, that's a really high potential return in an absolute sense. It's not in a relative sense compared to the risk that they have associated with them and the opportunity cost. So, you're not really getting that much of a proposed alpha return off of this company, even though it is a very high return, because it's probably going to be a very, very painful ride. Whether or not it's actually that volatile or not, and whether or not the volatility can benefit you, is up to the individual investor. But the point is it's not as great as that absolute return might imply, which this can be shown through my valuation score, which does take other qualitative factors into account. So it's definitely weighing in the low profit margin expectations and stuff like that, and other factors, which I get a 1.07, which anything over 1 is still pretty decent. But for something that's 17% plus absolute return expectation, you would probably expect this to be a little bit higher. So that it's being weighed down. That's my point, is that you can see that this is actually being weighed down, probably by the low profit margin expectations. My short-term pricing regression output does not really apply to this company because of the negative shareholders equity and the lack of analyst projection number. So this is not meaningful for this particular company. So anyway, that's going to do it for us today. I'm not entirely sure what we're going to be doing for the stream on Friday. I know our commenter today really wants me to take a look at INMD, but I'm not entirely sure if that's appealing to me or not. After I'm done with the stream, I guess I'll go look it up to get an idea of what this company is, if it's of interest to me. But there is definitely no guarantee that that's what we're doing on Friday. I technically already have an idea of a company that's of interest to me for a Friday stream, which is ticker HURC, Herco Companies. But I'm not sure. I might do one of those two companies. I might do neither of them. Uncertain at this point. So if you enjoy in-depth valuation content like this, please like the video, subscribe to the channel, all of that jazz. I stream 2 times a week around the time the market closes on Mondays and Fridays. The market obviously wasn't open today due to it being Martin Luther King Jr. Day, but either way, these are the times I like to stream, whether the market actually is open or not. So I will catch you all